Have you ever wondered how to use real estate to lower or even eliminate your taxes? The sponsors or general partners who run the big apartment deals routinely wipe out six-figure tax bills the first year they buy a building. Completely legally. No offshore accounts and no sketchy tax shelters. Just an IRS-approved two-step that generates huge paper losses for their passive investors. Stick around for a few minutes and I'll show you the exact math on a typical property so you can understand how the pros generate these tax savings for their limited partners. And if you watch until the end, I'll share a free resource that shows you how savvy investors save thousands of dollars in taxes by investing in real estate. But before we jump in, don't forget to subscribe and hit that like button. So let's get started. On a standard property, the building's purchase price minus the value of the land is depreciated over 27.5 years, giving investors their small share of the deduction each year. This is called straight line depreciation. On a $500,000 property, that's about $18,000 spread over 2 decades. Kind of a cash flow killer, right? Meanwhile, savvy operators look at the same building and they see carpet, cabinets, flooring, parking lots, and landscaping, stuff that the IRS lets you write off way faster if you simply ask. And it makes sense if you think about it. Some items inside a building wear down much faster than others. The IRS recognizes this and allows these items to be placed in different buckets. This is where cost segregation comes in. Cost seg is an engineering study that breaks a property into shorter-lived pieces. 5-year personal property, 7-year furniture, 15-year land improvements, and the rest that stays at 27.5 years for residential properties or 39 years for commercial. The study costs real money, but for the syndication, it's a huge win. On that same $500,000 building, an operator can commonly move 35 to 40% of the basis, or the total amount invested to acquire the asset, into the depreciation fast lane. Translation: about $175,000 now depreciates in 5 to 15 years instead of 27, creating an instant, bigger paper loss for the partnership. And here's where Congress sweetened the pot. The One Big Beautiful Bill signed on July 4th of 2025 permanently restored 100% bonus depreciation for any asset acquired and placed in service after January 19th of 2025. That means the partnership can immediately expense every component the cost seg study reclassified into a life of 15 years or less. So that $175,000 we just separated, the operator can deduct the whole thing in the first year, generating a massive paper loss that flows to you and the other passive investors. At a 32% tax bracket, that $175,000 deduction represents $56,000 of tax that simply is not mailed to the IRS. So let's see how this works for the partnership using our $500,000 property as an example. With the land value stripped out at 20%, the building's basis is about $400,000. Going the normal route, $400K divided by 27.5 years is a $14,500 first-year depreciation deduction for the partnership. But going the rich route, the cost seg study moves $140,000 to 5-year personal property and $35,000 to 15-year land improvements. The operator applies 100% bonus on both buckets for a total of $175,000 deduction on day one. Add in the remaining $225,000 straight line, and the partnership still picks up another $8,182, leaving total year one depreciation of $183,182. As a limited partner, you get a K1 with your share of that $183,000 paper loss that can shelter the passive income that you receive from the investment. And as a passive investor, if there's any paper loss left over, you can still use it to offset other passive income. For example, if you've got other passive investments in a short-term rental or a storage facility, the loss from this deal can be used to offset that income as well. It's important to note that the tax is deferred but not completely eliminated. If and when the property eventually sells, depreciation recapture can be up to 25%. But most investors simply use a 1031 exchange, which is the topic for another video, to roll the proceeds of the entire project into the next building, kicking that can decades down the road. And if you use this strategy over and over, you can defer taxes indefinitely. All right, so do you remember the old Tax Cut and Job Act depreciation sunset? That's where 100% bonus depreciation was being phased out over several years, dropping from 100% to 80% to 60% and so on until it disappeared forever. Well, Congress just tore that up. 100% bonus is back forever, at least until they write another bill. It's also important to note that the decision to take full bonus depreciation or spread that benefit out is made by the syndication's operator. So it's a key question to ask before you invest. Want to learn more about how this strategy impacts your potential return? Click the link in the description below for a free resource that shows you how savvy investors save thousands of dollars in taxes investing in real estate. All right, now let's talk about the process. First, your sponsor needs to hire an engineer or CPA who actually follows the IRS cost seg audit technique guide. Cheap cookie cutter reports by inexperienced people will not be accepted by the IRS. Second, if the operator's business plan is to flip within a short period of time, depreciation recapture plus capital gains taxes can eat the benefit of doing the cost seg. This strategy works best on buy and hold or short-term rental cash flow plays. Third, state conformity varies. California still ignores bonus, while Texas gives you 100%. So check with your own CPA on how your state treats it before you start celebrating the tax savings. Once you see this in action, your view of investing in real estate will change. In a recent deal, a partner invested $100,000 into a $20 million apartment building. Thanks to cost seg and bonus depreciation, their first year K1 showed a massive paper loss that offset gains from all of their other passive investments. When the property was refinanced about 4 years later, that partner received a tax-free return of capital and still owned their stake in the deal. This is how the rich use real estate to build tax-free wealth. Top operators aren't just finding good deals, they're structuring them in a way to be incredibly tax efficient for their partners. So let's wrap this up. Investing in a syndication that uses cost seg plus bonus depreciation is the closest thing to a legal tax superpower. The operator carves up the property, writes most of it off the first year, and you as a passive investor get to keep the cash you would have mailed to Uncle Sam to fund your next syndication investment. If Congress ever decides to kill 100% bonus again, you'll hear it first here. Until then, it's part of the rulebook that they gave you, and one of the most powerful strategies for building wealth with real estate. Don't forget to check out the link in the description below to learn how savvy investors are unlocking the secrets of the tax code to save thousands of dollars in taxes. If you got any value out of this video, do me a favor and like, subscribe, and share the content. It helps the channel out and gets the content in front of more people. I'd also love to hear your thoughts and answer any questions you might have, so make sure to leave them in the comments below. I read them all. And as always, see you in the next one.